All right. Good morning, everybody. If you don't know us, we are Chad and Jen Beasley with eXp Realty, and we do this every now and then where we just get together and chat about different topics. And this morning we have got Andy Gagliano and Shannon Driver from Gagliano Mortgage on with us, and we're going to talk about how we can serve our clients, whether it's sellers or buyers, using buy downs potentially. And they're going to educate us on all of that. And maybe we can brainstorm a little and learn a little from each other this morning.
Yeah, and before they go, we met with them and had coffee, and they shared with us the coolest thing that they have available to us. They have this new app that you can on the spot get a pre-approval letter for your clients. So we're gonna make sure they have time to share a little bit about that also. But right now, the market is just constantly shifting and changing, and having this tool in your toolbox to be able to figure out how to market buy downs if you have a listing, or how to potentially use it with your buyers to help them be able to get into a home. It's going to be just an incredible tool to have so that we can have a leg up and hopefully win in this crazy changing market.
I'm going to get my little pad and pen over here because I know I'm going to want to take notes. Well, Shannon and Andy, we will turn it over to you and let you kind of guide us through all of this.
All right. Well, give me just a second here. There we go. All right. I've got Costanzo in my office as well. He's watching, so you were getting my voice over his speakers 10 feet behind me, and so we're getting a little double talk here, but I think we got that fixed now. So good morning. I appreciate you guys having us on. Chad and Jen, thank you so much for the opportunity. And you know, you guys already know this. I'm not telling you anything that's going to knock you off your feet right now, but it's an interesting time. The great houses that are priced right are getting multiple offers. And it seems like those that are either not great or not priced right are sitting on the market for a little while until they either get great or they are priced right. And so anything that you guys can do to better the listing, make it more attractive, is going to do nothing but help your sellers. It's going to help you. And you know, if you look at this from the buyer side as well, this is a good opportunity to help your buyers out for any listings that they're interested in making an offer on. So, Chad and Jen, can you make me a co-host?
I made you a co-host, so you should be able to take it over.
Great.
Hey, before you jump into all of that, give us a little, maybe a 30-second update on where rates are and what's going on. You know, I think we got a little improvement this week, maybe, but what's going on today? Anything new?
Nothing new. The economic news today was a little good, a little bad, but you know, you kind of expect that when the market or when the economy is shifting from being very good to at some point, is what the Federal Reserve wants, is for the economy to be a little bit slower. So you go from all of the economic news being really strong to somewhere down here, whatever that number is, or that news that makes them happy as far as how much we are suffering, because that's what they're wanting, is for us to suffer a little bit while they're still getting that. Well, anyway, we won't get into all the politics of that. But
so for our world that we live in right now, as far as we're all wanting rates to come down a little, I guess the mantra, bad news is good news.
Exactly. That is exactly right. And so we're getting to that point now where we've gone from where the news, everything's been good, to now, you know, we're getting a mixed bag of news.
Yeah.
It's the natural progression for a slowing economy, and the Fed's looking for more and more of that. And so there's not much development today. There was a general feel in the bond market amongst the experts and talking heads there that the bonds were very oversold, which means that interest rates were very inflated, and probably more so than they should have been. And that was, you know, really happened about midweek last week. things kind of topped out there. The rates have been coming down pretty steadily since then. We've seen rates drop about 1/4 to 3/8% on our end. So just over a week's time, if your buyer locked in last Tuesday compared to a buyer that locked in yesterday, that buyer that locked yesterday is getting about a 3/8 of a better rate. So we're going in the right direction.
Yeah.
Only time will tell if this trend will continue. And at some point, where the rates are going to kind of level out. And that's what the Fed's looking for, is for those rates to level out, stay in that whatever range that happens to be, and stay there for a period of time, which is a good lead in for this, because again, when those rates level out, they're not going to level out at 3%.
Right.
I think there's a really good chance we've seen those days in our lifetime. And truthfully, I hope we don't see them again, because it's not good for the economy for them to stay that low, to get that low and stay that low. You have to have some sort of an event like a pandemic or a huge war or something like that. And none of those things are good. So, but I can see rates being in the fives and staying there, in that 5 to 6 range and staying there for a while. Some people are predicting, mid-4s to 5%, whatever, get down in that 5% range. And I think what we'll see is people who have sub-3 interest rates will start putting their houses on the market in order to sell and buy what they want to get a rate in the 5s.
I feel like with what we've seen recently, I mean, this is just my gut feeling, but I think if we can hit 6 or below, it's going to just open Pandora's box again. People start jumping in because they're afraid they'll go back up.
Yes. Yeah, totally agree with you there. So, that'd be a good thing. That won't be too bad. We'll get some more listings on the market and, maybe help out some of these first-time buyers, because they're, as you guys know, they're the ones that are really struggling in this market. Low down payment availability, and then a lack of inventory is not a good thing with bidding wars for them, but it's great for our sellers.
So one thing we've seen lately, and this segues into what you're going to talk about this morning, is some of the bigger builders are offering, permanent rate buy downs that have been real attractive for some of those first time buyers. Some of these builders that I won't name, but they're building, homes that are maybe in the low 300s. And, we had a buyer close with one last week where we had looked at some really good resale houses, up to about 300, but he ended up buying a house that was, almost 330, because that builder was buying the rate down at that time to 5 1/4. Now I think they've pushed it up a little bit, but at that time he got an FHA loan at 5 1/4, 30-year fixed rate, because the builder was offering that huge buy down. And so I think that's the thing, that kind of thing really helps the first time buyers. And so maybe some of the things you're going to talk about this morning maybe will help us learn how we can put our own sellers on a more level playing field with some of those builders that are doing that. But also on the buyer side, if you see a house that's been sitting for a minute, maybe there are some seller concessions we can negotiate that accomplish the same thing for that buyer.
That's exactly right. And that's a great point and a great real world comparison, because your sellers are having to compete, and especially in a lot of areas where there's still a good bit of new construction going on, like Chelsea, like Calera, areas like that, where you've got these new home subdivisions going in, and you've got a seller who bought in that subdivision 3 years ago, 2 years ago, whatever, and they want to sell or need to sell. And it's hard to compete against the new construction when they're offering an interest rate in the 5s.
Yeah.
And, the prices of those homes are not terribly far off from what the sellers need or want, or what you guys are showing that property is really worth. So, yeah, that's a great point. Well, you guys want to jump in and get started on this, and
yep, let's go.
Just see what we can do with it. So let me share my screen here. And you get to see the chaos that is my world with all the 800 tabs open in that.
I bet I could beat you.
Yeah. Oh, all right.
Makes
Somebody.
me crazy.
Sometimes I wonder how my computer keeps running.
It almost didn't yesterday.
Yeah, mine's struggling a little bit. I need to maybe close one of them and see what happens.
I did restart it this morning.
Oh, good for you. Yeah, mine usually gets its annual restart around New Year's. So, all right. So the first thing we're going to talk about is temporary buy downs. And so you guys that have never heard me present or heard me talk, look, I can bore you to tears with all the technical part of the mortgage industry and really put you to sleep. But that's not what I want to do. I want to give you information that's going to help you be better at what you do, help your sellers better, help your buyers better. And I want to be able to help you find buyers and find sellers as well. Now, there's not much that this presentation is going to do to show you how or where to find buyers or sellers, but this will help you get your buyers and sellers better positioned. And so any presentation that I do generally is geared towards how can you help this and use this to help you in your business, to grow your business and to serve your clients better. So we're going to talk about temporary buy downs and how to use those for your listings. So what is a temporary buy down? That's the question we get asked all the time. And it is simply a temporary reduction of the interest rate on a mortgage. And that reduction is for a predetermined amount of time and for a predetermined amount. So the interest rate reduction is a set amount. And this reduction is done to the interest rate at the beginning of the term of the mortgage. And of course, with every good comes some bad. There is a cost associated with the buy down. And we're going to talk about that in this presentation as well. And
where the buy part comes in.
Right. Yeah. And here's the other bad part. So in the good old days of the mortgage industry, think pre-housing crash of 2008, we could use a temporary buy down to qualify a buyer for a mortgage at a lower interest rate at the start rate of that temporary buy down. Now, in hindsight, we learned that was really not smart because that interest rate is not staying that low on the mortgage for more than 12 months. So it makes no sense to qualify them at that. So now on a temporary buy down, we qualify the buyer based on the note rate, not the start rate. So that's very important. And that's a big difference between a temporary buy down and a permanent buy down. And we'll talk about that a little bit later in the presentation as well. So, all right, this is going to get to the point to where I could put you to sleep. And I'm going to avoid it. So there are several different types of buy downs. There are three very common types of temporary buy downs. And we're going to talk about those three, but there are other options available. But the three most popular are the 3-2-1 buy down, the 2-1 buy down, and the 1-0 buy down. Now, I'm going to tell you about those in just a second, but there are other options like a 1-1 buy down. You could even make these buy downs be 0.5%, but the term of that buy down, the period of that bought down interest rate, I should say, can never be longer than 12 months. So it's always going to be based on an annual basis. And what you're looking at is a 3-2-1 buy down. The interest rate the first year is going to be 3% lower than the note rate. In the second year, it's going to be 2% lower than the note rate. And in year 3, it's going to be 1% lower than the note rate. Years 4 through 30, if it's a 30-year loan, that interest rate on that loan and the payment are going to be based on the note rate. And you can walk that example on down with a 2-1 buy down. Year 1, the rate's going to be 2% lower than the note rate. Year 2, the rate's going to be 1% lower than the note rate. Years 3 through 30, the rate's going to be the note rate on that mortgage. The 1.0 buy down gives the buyer a 1 year, 1% lower interest rate for their payment, for payment purposes. So before I move on, do any of you guys have any questions about that? Again, we could talk about all the others, but they're just not that common.
So you're saying that on these buy downs, you can't buy down. So like you couldn't do a buy the rate down by 1% for 2 years and then it go to the note rate. It's a 1 year and then it bumps to whatever's next. So you couldn't have it be the same for 2 years.
You actually can, but a 1-1-0 buy down would be the way to do that. So I don't know how they justify saying that that is not the same rate for longer than a 12-month period of time.
It's semantics. Tomato.
All that's way above my pay grade.
Yeah.
And, if I got to create these programs and these guidelines, well, I think the mortgage industry would make a lot more sense.
So what you're saying is if there's something that your buyer thinks might work for them, let's all put our heads together and see if it's something we can make work, because there is some flexibility in the way you can do these things.
There is. And, a lot of it too is going to depend on the lenders and what they'll allow.
Yeah.
We don't have a lender that is doing any sort of a buy down based on a 0.5% of rate. We're getting full percent rate buy downs, like a 2-1 buy down, 2% first year, 1% second year. I don't have a lender that's doing a 1.5 for the first year and 0.5% for the second year. It's allowable.
In my mind, something like maybe a 2-1 or buy it down by 1 point for a couple of years or something, to me makes a little more sense than something like a 3-2-1, because somebody starts at 3 points below the note rate and gets used to something that low. It's really a shock as you move up in those payments. So in my mind, it makes sense to do something that's, that helps them get to a point to where as rates come down, they can refinance into something that's similar to what they've been used to paying.
Yeah. And, there are reasons why the 3-2-1 buy down is something that's not extremely popular or used a good bit, I should say. And we're going to talk about one of those in just a minute.
Expensive.
But the other, yes, that's it. The other reason is, look at where rates are now. Now, no one knows where they're going to be in 3 years or 4 years, but I have yet to hear anyone who claims to be an expert about interest rates say that rates are not going to be lower in 24 months than they are today. Well, if somebody did a 3-2-1 buy down, yeah, they may enjoy that 3% lower rate the first year, 2% lower the next year, be it 1% lower that following year, but they're going to end up refinancing that mortgage if the talking heads are right. So why put all of that money for a 3-2-1 buy down into an escrow account that the lender's holding when you can do a 2-1 buy down that's going to be a cheaper option and still get your buyers to that point where they can refinance that mortgage in 24 months and get a permanent rate that's going to be 1 to 2% lower than where they are today.
And I guess the argument to the other side of that is if somebody does refinance out of a temporary buy down like that before it goes to that permanent rate, any part of that hadn't been used is refundable toward the principal, right? So they don't really lose that money that was paid in.
That's correct. Yeah. So when they get ready to pay that loan off on a refinance, or if they're selling, if there's still $3,000 in funds available, or I should say in that escrow account that the lender's holding to make those payments whole, then that $3,000 would be applied towards the payoff of that mortgage. So that money is not lost.
That's pretty cool.
That is, yeah. And that is a very important thing to keep in mind about that. So any other questions about just the buy down programs in general before we move on? Shannon, you're monitoring questions for us. You monitoring the chat?
Yeah, there's nothing in the chat at the moment.
Okay, fantastic.
Y'all jump in if you have questions. Don't be shy.
Yes, please do. So, all right, I think my 800 apps that I have open have caught up with me. There we go. Okay. So how much does a buy down cost and how exactly does it work? So here's an example of a 3-2-1 buy down. Now, before I go too deep into this discussion about the cost, how it all works, this is a buy down calculator that I created a little over, I don't know, a year and a half, 2 years, year and a half ago, I guess, at this point. And I'm happy to share this with you guys. There's one big thing here that that I want to point out to you. If you look down at column A, line 10, there's a pass fail for the seller concessions. So temporary buy downs do count as seller concessions or interested party concessions. And there's some confusion about that, or has been some confusion about that over the past couple of years when buy downs got to be popular again. And some lenders were saying that that is not part of it, that Fannie Mae, Freddie Mac, FHA are all very clear that these concessions are part, or the cost of a temporary buy down is part of interested party concessions and will go against that calculation for qualifying purposes. So if you have a seller that says, hey, we're going to, well, let's just look at it this way. Your buyer's putting down 3.5%, or let's go 3% on a conventional loan. Fannie Mae says the seller concessions can't be greater than 3% of the sales price. So we have to look at this when we're trying to qualify a borrower and say, okay, well, what is that the cost of that buy down, and is it going to exceed the 3% of the concessions? And that's what we were just talking about, Chad. In this case, the 3-2-1 buy down would fail the test, right, the interested party concessions. So we have to keep that in mind when we're looking at this. But let's start here at the top. So we're going to deal in this example with a sales price. Let's just round it up and say $420. With a 5% down payment, then you're looking at a loan amount of $399. Now, these are old numbers. We're not far off of this interest rate. So let's say the rate's 7%, a 30-year fixed rate mortgage. Your maximum seller concessions are going to be 3%. And let's skip down here and let's look at what the buy down is. So with a 3-2-1 buy down, the interest rate is going to be 3% lower than this note rate. So for the first year, the buyer is getting a 4% interest rate, and their payment is based on that. So we're looking at just principal and interest payments right here for the monthly payment. And what we have to do, the way we calculate the cost of this temporary buy down, is we take this payment and subtract what the payment based on the note rate, the 7% rate is, which is that 2654 number. So you're looking at the difference in those two payments is $750 approximately. So we take that $750 and we multiply that times 12. The cost of that for the buy down for the first year is almost $9,000. So the lender takes the $9,000 for that year, puts that into an escrow account that they hold, and every month they pull $750 from that escrow account, add it to the principal and interest payment of $1,904.89, and it gives them the whole payment over here of $2,654.56. So that's year one. Year two, the interest rate's going to be 2% lower than the note rate. So now we're at 5% for the buyer for their interest rate for year two. That's a payment savings of $512.64. Notice the principal and interest payment there of $21.41. So the savings is $512.64. That's your difference between your year four payment and your year two payment. And 12 months of that savings goes into the escrow account with the $9,000 that they put in for year one. So you've got another $6,000 going in for year two. With your $9,000 for year one, you're going to do the same exact thing for year three, which this payment savings there are $31.48. You add these three numbers together here, the $31.48, $61.51, and the $89.96, and that gives you your total cost of the, well, my drawing's bad. Your total cost of the buy down is $18,295.91. That far exceeds the 3% allowable seller concessions based on this sales price of $420,000. So this one would fail the test. So what I like about the calculator, of course, because I created it, is perfect. What I like about it is that it does give us a quick, easy answer of, are we going to have a problem when we submit a sales contract with a 3-2-1 buy down after you've gone through all that difficulty of negotiating between the buyer and the seller to get the cost of that buy down, that $18,295 to be paid by the seller? Is underwriting going to have a problem with it? Well, in this case, yes, underwriting is going to have a problem with it. Now, I just want to throw something out real quick. If your buyer's putting down a 10% down payment instead of 5%, now your maximum allowable seller concessions are 5%, and you pass because you're able to do 4.36 with this, or your cost is 4.36%. So there's flexibility here. The calculator does all of those calculations for us. So any questions about that before I move on?
So you can, is there any limitations you can do these things as long as it meets that maximum allowed seller concession test? You can do this across the board, whether it's conventional FHA, VA, and I know there's different, FHA allows a 6% concession and VA, what is 4%. So as long as you take all of that into consideration, you don't have any problems from one loan type to another.
Correct.
Okay.
Yeah.
Andy, we have a question from Jasmine in the chat. She says, would gift funds from a parent or grandparent also have to be factored into the allowable concessions amount? Can someone get a buy down plus a gift, or does that bust it?
That is a great question, Jasmine, and the answer is yes, it is still allowed. So you're talking about a gift from a relative is going to be applicable towards closing cost and down payment. That is not an interested party contribution, because that family member, mom, dad, whoever it is not getting paid from this transaction. Like your mortgage person, your realtor, your lender. So they're not an interested party in that respect. So,
okay. So the seller could offer buy downs that stay within that seller concession threshold. So they could offer a concession toward that. And then mom and dad maybe is kicking in, $5,000 for closing costs. And so then if that covers everything, all the buyer has to come up with is down payment and everything's cool.
Correct.
Nice.
Yeah. Yeah. All right. So the next example is the 2-1 buy down. Now you guys get the general idea of this. So I'm going to fly through these next two examples. We have a 2-1 buy down as an example. I've got a 1-0 buy down as an example. So I'm going to fly through these next two slides so that we can get to the rest of the presentation. But if you have questions, please do jump in and ask. So again, same example. Sales price 420, loan amount 399, 7% interest rate, 5% down payment. Max seller concessions are going to be 3%. Let's go down here to the bottom. If we're doing a 2-1 buy down, in year one, the interest rate is going to be 2% lower than the start rate, which is going to be give a payment of $21.41. I'm sorry. Again, $512.64 is the difference in the payment between the year one payment and the year three payment, or the payment at the note rate over here. So that's your $512 difference. Your total cost of that for the entire year for year one is $61.51. You're going to look at year two. The interest rate is going to be 1% lower than your note rate of 7%. And that gives you a payment of $23.92.21. Subtract that from your year three payment here, and you have a savings of $262.35. You multiply that times 12, you're at $31.48. You add your year two cost of the buy down to your year one cost of the buy down, and you get to be here at the cost of $9,300 roughly. So what percentage of the sales price is the $9,200? Well, it's 2.21%. And as much as I bragged on myself and my spreadsheet creating skills, what I've not figured out is how to change this pass to make it green so that you get a quick, easy indicator. But just give me a pass on the red pass there. But this scenario does pass and does meet guidelines. So
the cool thing about it to me is once you kind of understand it, it's very simple. I mean, the 2-1 is the same as the 3-1 minus the almost $9,000 that cost to buy down that first year rate by 3 points.
Correct. And
so it's pretty simple.
And we could go through on the next slide, and basically we can just do that, change this number here, and you essentially got the next slide. So let's look at that one. We're going to fly through that one. If my computer that's not happy with my 84 tabs being open will go to the next page.
So to me, what I was saying earlier, this example of the 2-1 in today's rate environment and where we expect to make so much more sense to me, because the buyer is making payments in that 5 to 6 range those first 2 years. And if rates go where we think they will in the 2-year period, they refinance and they stay in that range of what they're used to and they're comfortable with for the permanent loan instead of jumping up to 7. Right.
Yeah. Totally agree with you on that. And you know that payment shock's a real thing for buyers. And I know if any of you guys on the webinar have an adjustable rate loan or have a home equity line of credit, if you got a home equity line of credit and you carried a balance on that home equity line of credit over the past 2 years with all the Fed rate increases, you know what payment shock is, because those payments have done nothing but go up over that period of time. And so anytime we can minimize that payment shock for one of our buyers, that's a good thing.
Andy, in the chat, Tammy's asking, at any time can the buyer refinance during the buy down period? Absolutely.
Yes. And like we mentioned before, those funds that have been put aside, the cost of that buy down, I erased my writing on that other screen, but the cost of that buy down whatever's left in that escrow account that the lender's been holding for the buyer, the cost of that buy down would be refunded once that loan is paid off via a refinance or sale. So again, we'll fly through this, but you guys all know the numbers up here. Same scenario, same example. Year one, the interest rate is going to be 1% less than the note rate of 7%. The payment difference is $262.35. Add that or multiply that times 12, you get a total cost of $31.48. Put that total cost in here, and the cost of the buy down expressed as a percentage of the sales price is 0.75%, and that passes Fannie Mae guidelines. So that's how it works. Now, where is the benefit in this for your clients? So let me see. I think I have to go back in here.
So while you're finding your next screen, so if we're doing something like this, we're writing up finalizing a contract, writing it all up. Is there specific language we need to put in a contract for this, or does it just kind of go under a generic, sellers willing to contribute, $9,000 toward buyers closing cost prepaids and or in, rate buy down or something like that?
That's exactly how I would phrase it. It really doesn't have to
Okay.
be anything special. Just add that closing cost and or prepaids and or temporary buy down, temporary interest rate buy down. So that is a phenomenal question. Thank you for asking that. All right. So who benefits from the temporary buy downs? Well, pretty much everybody involved in the transaction. Buyers, sellers, the neighbors benefit, because we're going to talk about that in just a second. And you guys will benefit as well. So how do your buyers benefit from a temporary rate buy down versus, say, what almost every single buyer wants? It's immediately what comes to mind when they see, want to make an offer on a property and want to negotiate, and that is a price reduction. So if we use these same numbers that I've showed you guys in this example, a 420 sales price, basically a $399,000 loan amount, 7% interest rate. Instead of doing a $10,000 price reduction, instead of your buyers asking for a $10,000 price reduction, if they did a 2-1 buy down over 12 years into that loan on the mortgage, remember, they're getting a mortgage for $9,500 more than they would if they'd asked for a $10,000 price reduction. So think about that. Over 12 years, the buyer would have paid in principal and interest payments on this loan $378,266. So that is their total payout over 12 years. If they asked for a $10,000 price reduction instead of the buy down at full price of $399, they said, "Hey, not $399 for a $419,999 sales price." Instead of saying, "I want $10,000 off that price," if they took $10,000 off that price in 146 months, the buyer on the mortgage would have paid $378,245. So essentially, the break even for the buyer is 12 years, even though with the 2-1 buy down, they're getting a mortgage for $9,500 more than they would have gotten if they'd asked for a $10,000 price reduction on that property. So what I'm telling you is, short term for your buyers, a 2-1 buy down is a great option, and really a better option than asking for a price reduction on that property. So that leads me to ask the question of, what are the odds that your buyer is still going to have this mortgage in 146 months, or still own this property in 146 months? And the answer that we all hope and pray we get to that question is this: I hope that your buyers don't have that mortgage or don't own that property in 12 years, because that means that you've gotten another paycheck and or I've gotten another paycheck, and paychecks make the world go round. So that's what we all want. So let's look at it from the seller's perspective. And look, this is not a huge benefit for your seller, other than dollars and cents wise, other than the fact that it gives them another little marketing advantage. But let's look at the cost for the seller between a $10,000 price reduction or offering a 2-1 buy down to the buyer. So a 2-1 buy down costs the seller $9,299 at closing. They are going to pay you, their realtor, an additional $600 in real estate commission versus paying lower commission at a lower sales price. Remember, we're just comparing these two scenarios, a lower sales price or a buy down. And if they decide to lower the sales price instead of offering a buy down, then they're losing $10,000 in lost equity, but they are going to save $600 in real estate commission because they're going to pay you guys less to do your job with the lower sales price house. So if you look at it, $9,900 is the cost to the seller for a 2-1 buy down versus roughly 10K savings or costs, I should say, in lost equity on this deal if they do a $10,000 price reduction. So not much of a difference there in dollars and cents for them, but it does put another arrow in your quiver as the realtor, because now you've got something to make this listing more attractive when a potential buyer is looking and comparing this listing, your listing, to, say, like Chad mentioned earlier, new construction. So this is going to make your listing a little more competitive against that property, that new construction property, or some of, one of the listings down the street, that instead of getting into a price war between your listings in a neighborhood, offer this buy down or ask your seller to offer that buy down, and then you're helping out the seller, you're helping out the neighbors as well, because your comps are going to end up being better if you're not cutting those prices on them. So pretty much the same benefits for you guys that I just talked about. The benefits for you as a realtor, if you can get your seller to do a temporary buy down, are going to be additional commissions. Now, look, we don't do this job just for a commission, but if we don't get commissions, we can't do the job. So it's not the end all be all. It's not why we do everything that we do day to day. That $600 that you're going to make in commission is not going to be something that sways you to do something you wouldn't ordinarily do. But why not make an extra $600 if you can make the $600 and ask your seller to do the 2-1 buy down instead? And again, it's going to give you guys an additional little competitive advantage for your listing and an opportunity to market that. And so that sometimes leads the question when I give the presentation of, well, how do we make this known in our listings? And you tell me, Chad and Jen, if this is allowed or not, because you're the experts and I'm not. I'm just going to bump back up here. If you had the interest rate, the temporary rate buy down calculator, and this was your listing, and you entered those numbers in there, and you took a screenshot of this page right here, and you put that as one of your pictures, one of your photos for the listing, is that allowed by MLS?
That is a very good question. I mean, I will turn that question back around on you and ask you, does it meet all the requirements of, when you're touting rates and payments and everything, of APR disclosures and all that kind of stuff?
Great question. And no, it does not have the APR on there. So I'll add an APR on there and we'll make it legal.
Okay.
And
so then at that, I think it would be okay, but I would encourage anybody to run it by their broker before they do it. Now I've covered my backside.
There you go. There you go. And I will go in and add that APR figure in there, and we can, as far as lending purposes, that would be totally allowable.
Okay.
Well, and I would think that even if you couldn't put it in MLS, I mean, we all market on social media, and if that's on there, I mean, that.
Yeah.
Again, you want to run it by your broker,
yeah.
but
I mean, look, the beauty of this is, I mean, like you've talked about, the difference in in this example, and honestly, in a lot of what we're doing, because average price points have pushed up, and so you look at a $10,000 buy down versus, or a $10,000 price reduction versus a 3% buy down on a $300,000 or more house. They're kind of essentially the same for the seller. So what the difference is it's a marketing thing, right? We're looking at what is the pain point, what are the problems that buyers have out there, and how can we solve that problem to help put buyer and seller together. And that's essentially what this does, is it helps us solve that problem. Of the only problem it doesn't solve, that's got kind of, I think we've got two things going on with buyers right now that have got them a little bit frozen. One is the rate thing. And this helps solve that. Especially if they buy into and understand that rates are likely going to trend lower, so that they could refinance in the future and have a permanent rate that's better for them. The part that this doesn't address, and that discussion for another day probably, is that segment of the population that still is hanging on to 2008, and they think we're headed for a market crash, and they're scared to death to buy a house right now because they think prices are going to go lower and they're going to get stuck.
Yeah.
I think, the laws of supply and demand fly in the face of the people that think that, but that's another side of it. It's a discussion for another day. But I love this because it's, if you can sit down with your seller and you can explain to them, that it's really no difference to them if they're thinking about reducing the price to be more competitive. Why don't we try this? And we can tout it as, hey, we can take that $10,000 and offer it as it's flex cash, buyer. We're offering $10,000. You can use it to knock off the price. You can use it toward closing costs and prepaids. You can use it toward a rate buy down. However you want to spend it, here's the money we're offering you, and you get to choose where you apply those funds.
Well, and I look at it as, what did we start off this conversation with? We all said, if we could just see rates get to 6%, we think everybody would jump back in. Well, this is the marketing tool to help get to that magic rate where you might not have to reduce the price, because a lot of times when we have those conversations with our listings, a $5,000 price reduction really isn't going to make that much movement and get more eyeballs on their house if it's sat there for 2 weeks. But something like this, if you could add an attractive, like Chad said, flex cash of, how would it, that's just kind of like a cherry on top, because the prices are not really dropping. And so if we just had better interest rates to help those payments be a little better, we think they would jump back in and, it would move. So it's just a different way of looking at it. I see every day on where we've got buyers set up in Collab Center, and I, looking at those listings every day and you're seeing price change, when really people need help on their monthly payment, not the actual total cost. A little bit of reduction like you showed, it's just not going to make that big of a difference. They're going to get more of an impact.
Andy, with where rates are right now, what kind of difference is a $10,000 price change making in payment? Like $60?
Yeah, say $65.
Yeah,
you're right on.
Versus the buy down helps that so much more.
Exactly. That's exactly right. Yeah, I look, it's why you guys are so good at what you do. You both hit the nail on the head. And
Tammy posted a question. She said some sellers may be afraid to offer the buy down rate versus lowering the list price, because if the home doesn't appraise for the list price, they are still contractually obligated to pay the buy down rate. How would you handle this concern when speaking with your listing client? I would say, one, don't price it where it won't appraise. That's the first step. But two, you could put language in the contract, or just have an understanding up front that, hey, if the house doesn't appraise, the first place that funds are going to be taken away from is in that seller concession. Because we can't afford to, if the house appraises $10,000 low, we can't afford to come down 10,000 to the appraised value and still do the concession. So whether you put that in the contract or you just have that understanding up front that if this occurs, we're all on the same page that we're going to have to work through this, and we can't do both.
Yeah,
But the first thing is be sure you price within the comps, and then you don't have that problem.
great answer and great question too. So, all right, I'm going to you've been looking at this slide, so obviously I'm going to show you the slide, but we're going to talk about real world. All right, this is not real world, what I'm showing you on this slide. Now, I did leave one interested party to a transaction off of this list, and that's the buyer. But a buyer can fund their own buy down. Why would a buyer do that?
That doesn't make a lot of sense.
It doesn't, unless, and this is one of the reasons why, one of the many reasons why I love Jasmine. She's a numbers person, and she's always thinking about how to put a deal together. So the numbers person in her is thinking, hey, if we get a gift from a loved one and we get concessions from the seller, are those two numbers going to be combined and possibly exceed what the allowable concessions are for Fannie, Freddie, or FHA or VA? And the answer to that was, of course, no. But if the buyer's got parents who are willing to give them a gift, the seller's not willing to do a temporary buy down, and the funds work out with the gift funds, then the buyer can do that. Still, I look at it and I say, hey, take those gift funds that you're going to give to the lender to hold for you in an escrow account that is going to earn you $0 in interest.
Right.
And
Go
give
get
those
5%
funds
somewhere.
Yeah, give those funds to a great financial advisor who's not going to buy Bitcoin with it, and pull money from that account each month to make that mortgage payment for you, that difference in the mortgage payment to get it comfortable for you. So I didn't put the buyers on there, but they are someone who can pay for a buy down. The sellers can pay for a buy down. You guys, you realtors, can pay for a buy down. We, the lender, can pay for a buy down.
That'd have to be a big old house for me to contribute that kind of money.
Yeah. So, like I said, that's what the guidelines say. Let's look at the real world.
I like the real world.
The real world is you guys work too hard for your money. The real world is interest rates are what they are right now, and we are not in a rate environment that's conducive enough for us to be able to pay a buy down, for a temporary buy down, I should say, for a buyer. So that's just real world, and that's today. Now, in a month, 6 months from now, that could be different. And I'll show you how that works here in just a minute, because we're going to talk about permanent buy downs, and they're very, very quick and easy, much easier than this. But do you guys have any questions about temporary buy downs before we move on to permanent buy downs? Again, 5-minute discussion on a permanent buy down. I'm going to go to the next slide, and if you are typing a question, don't worry, we will get to it. All right. So the other option as far as a buy down is concerned is a permanent rate buy down. It is exactly what it sounds like. It is a fee that is paid to the lender to permanently buy the interest rate down to a lower than market rate. And that lower rate stays with that loan for the life of the loan. Here's another big difference between a permanent and a temporary buy down. I told you on a temporary buy down, the buyer does not qualify at the lower interest rate, the bought down rate. On a temporary buy down, the buyer qualifies at the note rate. That's a big deal. On a permanent buy down, the borrower does qualify at the lower interest rate, because that rate's going to stay the same, assuming it's a fixed rate loan, over the life of the loan. So they would qualify at that. Permanent buy downs can be paid by, again, realtor as a concession towards closing cost, mortgage lender, seller, buyer, all of that would be a contribution towards closing cost. We'll pause on the real world discussion again, because we know that's really not going to happen. And thanks to good old Uncle Sam, there are limitations on how many discount points can be paid in order to permanently buy the interest rate down on a mortgage. I don't want to get into all that. That's a lot of technical talk and getting really deep into the woods. But just know if you have a buyer that says, I want to pay 6 discount points to get my interest rate down to 4.5%, probably not going to happen just because the guidelines are not going to allow it. So let's look at how a permanent buy down works. Now, this is real world as of yesterday. We have let me turn my little pen on here again. All right, we have a loan amount of $399, 30-year fixed rate mortgage. Yesterday's loan with no points, no discount, no origination fee, 7.375, no points. All right, that gives that buyer a principal and interest payment of $27.59. Now, what if the buyer says, hey, instead of paying no points, I can afford to pay a 1% discount to get my interest rate lower? Well, we weren't quite exactly at 1%, but if they wanted to pay 1 point, which is a point is 1% of the loan amount. So in this case, 1% of $399 would be $3,990. That would be added to the buyer's closing costs. So they could pay a little over 1 point to get their interest rate to 6.875 compared to 7.375 with no points. Now, what this does to their payment is it makes their principal and interest payment $26.21.15, which is a savings of roughly $134 a month savings on a payment. Multiply that times 360 months, and that's the total savings in interest over the course of that loan. But that's not told me what I really want to know. What I really want to know is, where's the break even? At some point in time, a buyer can continue to pay points to get a lower rate, but they're going to hit a point of diminishing returns to where the money they're paying in dollars over here in this column does not make sense and does not equate to what they're saving in payment over here in this column. So what I like to do when a borrower says, hey, I want to pay some discount points to get my rate lower, is I want to look at what the break even is. And the break even in this scenario, just comparing these two rates, the 6.875 and the 7.375, the break even is 33 months. So what does that mean? So what it means is if the buyer is willing to pay $4,488.75 in additional closing cost in the form of discount points in order to get a lower interest or a lower payment of $26.21 to save that $134 between this rate and this rate. Savings is $134. The cost is $44.88. If they took that $134 in savings every month and put it into a piggy bank, earning no interest, it would take them 33 months of putting that money into that piggy bank to equal what they paid up front to get that lower rate. Every single one of these rates that you see, let me come over here on this side. Every single one of these rates that you see here are comparing this rate to this rate, the one with no points. So if the buyer said, hey, I have a 1.5 discount points I can pay to get a lower rate, that gets them a 6.75 rate. And as long as they keep this mortgage for 36 months or more, they're going to save money by getting the lower rate. Again, remember what I said about interest rates. All the talking heads are saying interest rates are going to drop. And if interest rates drop in 2 years, what we typically say as a rule of thumb is that the rate has to be about 1% lower for a buyer or for a borrower at that point. The rate needs to be about 1% lower for them to refinance, for a refinance to make sense. So if they buy the interest rate down to a lower rate by paying almost 1.125 discount points, they buy the interest rate down to this rate, the 6.875 rate, and at some point in the future, rates will have to drop to about 5.875 in order for it to benefit that borrower to refinance. So it's a gamble for the buyer. It's a gamble for the mortgage lender, because the mortgage lender doesn't want this loan being paid off at 6.875 or a new loan at 5.875. They're earning less interest on that loan over the life of the loan. They want interest rates to be higher so they can make more money. So it's that trade-off of how long is this buyer going to be in the house, number one, or how long are they going to have this mortgage, number two? Are they going to refinance it, or are they going to hit the lottery and pay it off? Are they going to have a very rich uncle in Nigeria who's going to pass away and leave them $34.28 million, and they're going to pay it off that way? So that's the gamble that we look at and that the buyers take with a permanent rate buy down. And we have to look at both of those things now. Whereas in the past, when rates were really low, we really only had to ask them one question, and that is, are you going to sell your house within 33 months, in this example, or pay the loan off within 33 months? And if the answer was no, then we would say, get the lower rate, pay the money to get the lower rate. But now, because interest rates have bumped up, there is a good chance that that buyer is going to be refinancing within 12 to 24 months. So we have to ask the question of where are rates going to be in 12 to 24 months? And do you think the rates will be at 5.875 where you would benefit to refinance? Does that all make sense before I move on?
That's to me, this scenario right here is what sort of makes the temporary buy down attractive in my mind. And if we can all find a way to communicate this kind of stuff to our buyers and sellers out there, but more buyers in this scenario, on the temporary, if you know, let's say you've got a 2-1 buy down and in a year the rates are better and you refinance, well, you don't lose that money that's been put aside for that buy down. It gets credited back and goes toward the principal. In this scenario, you've paid it up front and it's gone. When you refinance it, that $4,000 or $5,000 that you permanent buy down doesn't come back to you.
That's correct.
Hey,
Now-
and real quick, because I want to make sure we talk about your app, but if we're continuing to record this, so if any of
we
y'all
can stick
have to
around.
jump off and you can watch the end of it. But this is such good information, and I think we're learning so much. We're going to keep going and we want to get it all in, but just know that this is being recorded. We'll put it out there and y'all can jump in and get what you missed at the end.
Yeah, thank you.
You're welcome.
And we've gone through the meat and potatoes of it, but yeah, Chad, you're right. And you know, we do this for every single buyer that comes to us before they get ready to lock in an interest rate. Now, if they're coming to us for a pre-approval, I'm not doing this for them. I'm going to talk to them about it. I'm going to explain it to them, but I'm not running these numbers for them because they're going to change. That's yesterday's numbers. I will guarantee you they're going to be different today.
Yeah.
So we look at this for every single one of our buyers before they lock an interest rate in. When they come to us and they say, we've got a contract on XYZ property, we'll run this, send it to them, take the time to go through it with them, explain what the break even is, ask them that question. How long do you see yourself in this house? And what do you think rates are going to do in, so let's say 22 months, for example, if you look at this 7.125 rate, break even's 22 months. Do you think rates would be 1% lower than 7.125? Of course, the question always comes back. Well, what do you think, Andy? You're in the business. You know, yes, no. I mean, I can give you my 2 cents all day long, but that's what we go through with every single buyer. And it's important for them to know their options. You know, what we're seeing a lot of right now, it drives us crazy, quite honestly. We are seeing almost every single online national lender is sending these worksheets or loan estimates to buyers with discount points to permanently buy the interest rate down.
Yeah.
And when we see that, what we see is closing costs that are at a very high number, because these discount points are in addition to normal closing cost. So if normal,
Yeah, I've seen some of those that you're talking about where the people get all enamored by the rate, and I always ask them, what's it going to cost you to get that rate? Have they told you that? And then when they start digging into it, they're like, oh, you're right. And when there's like 3 points built into it or something like that to get that rate.
Exactly. Yeah. So, you know, that's what they see. They see this number right here. They see the shiny lure without the hooks, but they need to know that there's hooks on that lure and that they could get caught. And so that's why it's important for us, being the professionals that we are, to point out, hey, look at your closing cost. And would you like to see a quote from another lender who can quote you an estimate based on rates without these exorbitant costs that you're seeing, these exorbitant closing costs? Because the real world, again, the truth of the matter is interest rate and closing costs are married. The higher the rate, the lower the closing cost, and the opposite is true. The lower the rate, the higher the closing cost. And so it's up to us to educate our buyers accordingly.
Well, and Andy, I'll say too, I mean, and you do a phenomenal job with this. I mean, this is why it's important for us as realtors to, you know, look, most of us aren't going to dive in and know all the ins and outs of how all of this works and the intricacies of it. But we need to know enough to at least have the conversations and then hand them off to a deeper conversation with someone like you who can walk people through these scenarios and how they work in a, you know, an easy to understand but very knowledgeable way, because there's so many lenders running around out there that they're just trying to find a square peg to stick in a square hole, and they don't understand the nuances of different things. They don't want to know it. If you don't fit the box, they don't want you, or they're just lazy, you know, or whatever. So it's really important for us as realtors to find trusted mortgage advisors who understand this stuff and will take the time to explain it to our clients. And then, you know, we have a little bit of a responsibility to know enough just to be able to start the conversations and to go, hey, there are some options. And for us to be able to intelligently communicate some of this stuff to let people know that there are other ways. And part of it, I think, too, with the I think some of the stigma, if that's even a thing, for the temporary buy downs is people are so scared to death of adjustable rate mortgages. And the temporary buy down is really not that.
Right.
It sort of is, but it's not where it's going to continue adjusting for the life of the loan. So I think that's part of it on us, is to educate people that this is a good tool to get us to the point to when we can, you know, you would be able to refinance, but you're not exposed to it going above that note rate and what that permanent rate is. So I think there's a lot of educating to do on that.
Yes, absolutely. And it's what you said, you know, the more that we know about mortgage, title, appraisals, closings, home inspections, run down that entire list of all of the service providers that we use, all of our team that we use to close a deal. And we are 100% a team to get a deal done. The more we know about those services, the more professional it makes us look. We don't have to be the experts, but the better it makes us look, and the better we can look to a buyer or seller, the better chance we have of getting that buyer or seller and keeping them for their entire lifetime. And so Yeah, I agree with you. And this is just one of those tools. This is, knowing enough about a temporary buy down is not going to make you an expert on mortgages, but it will give you a benefit when you go into a listing agreement or listing appointment, I should say, with a seller, and your competition has not even mentioned, hey, down the line, we don't necessarily have to do it today. If you want to do it today, we can, but this is something that's available as a tool to help me market your listing and sell your home. And if the next agent that comes in behind you doesn't talk about a temporary buy down, maybe this is what you need to win the listing. So you're exactly right. Exactly right. So, hey, I want to plug Gagliano Mortgage for just a second. Can I do it?
Absolutely.
It's going to be longer than a second, but we do 2 events, normally 2 events a month, realtor events, I should say. One is a lunch and learn, and the other is a mastermind. At the mastermind, we have people to come talk to us, to present to us and the realtors who are there, who are professionals and experts of what they do. And last month, we had a great mastermind about networking. And I don't know if she's still on here or not, but the presenter for our mastermind was actually on this webinar with us. And she did a phenomenal job. She's an expert at networking. Her sales results prove it. This month, our mastermind, we're going to have a social media panel. And right now, we've got 3 phenomenal agents who are doing a very good job. They made a commitment this year to really step up their game on social media, and they've done it. They're generating leads on social media. They're generating closed deals using social media, and they're going to be talking about that. And look, these panels are great because it gives us an opportunity to pick their brains and really dig in and ask them what's working for them and what's not. So that event is going to be Wednesday, September the 20th from 9:30 to 11. We'll have some coffee and maybe I'll have my normal 1 chocolate chip muffin when I go, but that we'll have a little bit of something there just to kind of snack on. And we have a link down at the bottom. The QR code is actually a link to our link tree where you guys can just take a picture of that with your phone and you can sign up for these events to come to them. But earlier in the month, we're going to have our mastermind and we're going to have our lunch and learn where we're going to feed you. I don't know. Oh, tzatziki's. Okay. So we usually do tzatziki's or taco mama. This month is tzatziki's. And we're going to talk about our app that we have, which is incredible. It's an opportunity for you guys. I don't know if you struggle a lot with this, but it seems like you guys, you work so hard and you work such, I'm going to say, not odd, but not typical hours. You're writing sales contracts at 8:00 at night on a Wednesday, and your mortgage loan officer that needs to send you a pre-approval letter for that offer is at church, or you're writing an offer at noon on a Saturday and your loan officer is at the lake. And how do you get this pre-approval letter that you need to submit with the offer? Because all offers are due by 1:00. They always are. So, and my phone's ringing. Apologize, but that's going to go for another minute or so. But with this app, once we get someone pre-approved, you guys can actually go in and you can generate your own pre-approval letter. The buyer can generate their own pre-approval letter. In addition to that, once that buyer is under contract, then you guys can follow that application through the entire process. When there's a new milestone reached of, hey, we've ordered an appraisal, we mark it in the app, you get notification of it. When we submit a filed underwriting, we mark it in the app, you get notification of it. Clear to close, we mark it in the app, you get notification of it. So it's a great way for you to stay up to date on what's going on with your buyers. It will never replace the communication, the dialogue that we have. We're going to call twice a week. We always do that with updates. But it just gives you that opportunity when you wake up at 3 o'clock in the morning and you're, oh my gosh, did the appraisal come in? Well, chances are we've already called you on the appraisal anyway, but you can pull up the app and you'll see that the appraisal was in, that it appraised for the sales price or the appraised value was enough, and that there are no required repairs. So it's a really great tool. We're going to go through all of that at the Lunch and Learn, show you how to use that. And then I just want to tease this one a little bit because I'm fired up about it. I love fall. October is probably my favorite month of the year, not just because I was born in October, but that might have a little something to do with it. But in October, our mastermind is going to be all about spooky title and closings. So we're going to have title reps and closing attorneys come in, and it's going to be a panel again. They're just going to tell stories about things that have gone wrong in closings, crazy situations with title. It's going to be a great opportunity. It should be extremely entertaining, should be extremely informative, and I'm fired up about that. We've got a great panel put together so far. I think we've got one more seat to fill on that one, and I'm very excited about that. But if you guys will go and just scan that Linktree QR code down there, you'll get notification of the October mastermind as well. So I told you I was going to go longer than a minute.
That's perfectly okay.
Yeah, we just can't thank you enough. I mean, this is fantastic. It makes us stronger, better agents. We are more professional because of this knowledge, and y'all always just give back to us as agents so much with your expertise. We love partnering with y'all and appreciate your time today coming on and doing this.
We appreciate the opportunity. We appreciate to partner with you guys as well, and appreciate you giving us this time. You know, this, like I said, is a total team effort. None of us could do this job and get a paycheck at closing without each other. And so it's great to have good team members like you guys, and we really appreciate you. So,
all right. Well, we will work on this Zoom link that we'll get it to y'all so y'all can send it out to agents that y'all invited that missed it. And then our team will have it up on Facebook for our EXP group. And we just appreciate it.
Well, thank you so much. Yeah,
Great.
we appreciate you guys. Y'all have a great day. Make some money.
All right.
The houses.
Bye.
All right. Bye.